And live.
All right, we are live. Hey, have you ever wondered if trading stocks is as unpredictable as rolling those dice at the casino? You know, well, if you do, maybe it's time you learn how to become the casino. And today on Trading Truths podcast, Mike Lamothe and I are going to be talking specifically about that. We're going to basically shed some light on the common myth that trading is gambling, because for some of you, the way you're trading, it is gambling. So, Mike, is the myth about trading being like gambling true or false?
You know what? I actually think that it's true. I think that trading is like gambling, and the key, like you alluded to just a second ago, is that you want to be the casino, right?
Okay.
Casinos are gambling. Yeah,
Yeah.
they create the room for us to gamble. So what we want to do is we want to be the casino. We want to just have the odds in our favor. Where if we trade the same way 100 times, we know that we're coming out a winner at the end of the night. That's basically what we want to set up for ourselves.
Okay.
But there's lots of ways that you also said that, yeah, that for so many people, for myself included, well, when I first got started and really for the first 10 years that I was trading was gambling. And it
Okay.
was
Yeah.
because I didn't have a plan. I didn't have a plan. I didn't have a great way to manage risk or emotions or anything. I just thought, take some money, you put it in, more money comes out the other side. Hey, you know what else does that? A craps table every now and again.
Yeah, so it's kind of like, so you were trading the way some people, when they go to Atlantic City or they go over to Las Vegas or something like that, where you go into a blackjack table and you haven't got a clue what you're doing. You kind of know, you read a book about how to make money trading, not in trade, but make money playing
Mhm.
blackjack. And all of a sudden you're getting whacked up and hammered, and
Just enough to be dangerous.
yes, and you're making multiple trips to the ATM machine. Oh, that was a personal story. I didn't want to get into that, but 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 it is one of those really challenging things. Uh, and I think that majority of us traders start there, where we're more driven. We see the opportunity to make a lot of money, but we don't have the structure to be able to make the money. In other words, the plan, the discipline, and all those type of things. And we wind up being very impulsive and compulsive in our approach, and just figure that, well, if I just throw money at it, I've got to get that magic word lucky one of these days. And we don't realize that when we do that, the odds are not in our favor of being successful, right?
Yeah, exactly. No, it's. I think that, well, when you have not just a plan for the trade, but a plan for how you're going to operate, period. Like
Right.
not just on this one trade, but how I'm going to operate over the next 100 trades, over the next 1,000 trades. Well, whatever it's going to be, like some sort of standard operating procedure that says that here's specifically what I'm going to look for. Here are the conditions under which I'm going to look for it. Here's how much money I'm going to be putting in. Here's how much I'm going to be contributing. All these different elements to it, right? Like it sounds almost more like a business than, I don't know, something where I just picked up a book one day, flipped through it. Oh, wow, I could make a bunch of money doing this. I just read a comment on YouTube that says that, hey, if I just make $500 per day on a $50,000 account, I could be making 10 grand a month. That
Yeah.
sounds pretty easy,
Yeah.
right?
What is easy, right?
Yeah,
And
sure.
but yeah, sometimes with traders or people, when they do that, they approach it from that perspective, and on paper they write it all out and it looks good, But then it comes down to the actual execution of that. But let me throw you a curveball about
All
this
right.
gambling thing.
All right.
How,
Hold on. Hold
okay,
on.
you ready? You ready? Here's a
I'm ready.
curveball coming at you. Is how many people use trading is like gambling as an excuse not to get into trading and start growing wealth. They go, well, there's too much risk. And when somebody says that, how, excuse me, but how ignorant are they? I would say stupid, but my wife would come down and yell. Oh, I did say that, but my wife would, no, but how ignorant are they to think that well, I'm not going to learn how to trade because it's gambling.
Well, it could be from a place of ignorance. It could be from a place of pain. So the way that you just described it, my dad actually told me that trading is gambling, and that don't do it. And the reason why was because he had gotten burned trying to trade. I forget what stock he attempted to put money into. This is going back into, I want to say, the late 80s, early 90s. It might have been Disney or something like that, where he put money in. It started to move a little bit in his favor, and then it dropped 10%. Of course, he has no reason why. Didn't really have much of a strategy or anything. Just put the money in, and then he told me that he immediately went to go take it out after the stock dropped, and he's like, "Never again."
Yeah. Now, well, that reminds me of a story. My mom and dad too, similar type situation, is they had saved some money and all that kind of stuff, and they were primarily just investing. They were putting their money in the savings and loan that was paying like 6% or something like that. A broker, financial planner or something got with them and said, well, if you put your money in the stock market, it's going to do this. Here's the average and all that kind of stuff. And wouldn't you know it, that uneducated or people who lack a plan will oftentimes find themselves drawn to the market when the market is approaching, what it's approaching, right? The highs, right? That's where the exuberance of, oh, everybody has to get in, all that kind of stuff. Well, that's what they did back in 1976. Mom and dad opened up a brokerage account and bought some mutual funds, right? Well, it just happened to be they bought almost at the pinnacle of right before a bear market took off and lasted for a little bit over a year. And it was around 76. And the so after that took place, they said never again. Now, of course, they missed out on the rest of it, and just a little bit more reading and education, because there were great books available back then too, they would have been able to see, oh, okay, yeah, this kind of stuff happens. So yeah, interesting perspective on that aspect of the lack of understanding and knowledge that's readily available causes people to have a bias towards trading stocks that in reality impacts their whole legacy, the legacy of not only their trading, but also the legacy of their family, because they could be building significant wealth if they weren't so hung up. You know what I'm saying?
Right. So for people who let me rephrase. I think for everybody, it's very important for us to list out what our beliefs are about trading, right? Like I mentioned this in both of the books that I've written, the Mara Mindshift Guide, the Trading Beliefs
Right.
Workbook, and also in the Trading Mind Wheel. If there's thoughts like that swimming around in the back of our head, and we're not aware of them, those are the kinds of thoughts that'll trip us up at key moments when all of a sudden price is moving against us. Like, oh, well, the market's rigged. It's a gamble. screw
Right.
this, I'm taking my money out and I'm going home.
Yeah.
And just like with the story that you told, you end up missing the investment of a lifetime by just taking everything out and going home. Though if we could take inventory of those types of limiting beliefs, line them up well, and also take that juxtapose them against what our goals are, then we could start to reconcile, well, what's helping us get to our goals, what isn't, well, what needs to change.
Okay. Yeah. No, I love that. So because
And I think
with my mom and dad, they actually it turned out that there is a happy ending. It's when they, and I don't recommend this to anybody because I don't really think anybody should trade with somebody else, or don't trade for your mom, don't trade for your dad, especially because oftentimes when I was trading for both my mom and dad, it went really well. We were able to build up a nice account for them that actually wound up taking care of my mom in the place that's, the rest home that she had to go to later on. And so we built the account up to be able to do that. But what was really funny is when dad was alive, dad had a very positive and wonderful outlook on life, and his money grew and flourished. Mom, on the other hand, had a very negative, outlook on life and money and this type of thing. Was always scared of taking a risk. And what was really funny is when dad passed away, the funds actually, it was harder to trade for mom because this sounds weird, but her fear transferred, I think, to her money. And you know what they say, scared money can't make money.
mm,
And it was a challenge and so, you know, it's true. I mean, it was absolutely true. It was, we basically maintained what she had, because every time I put a trade for her, even a great trade, a high probability trade with the odds in our favor, it was like magic. I mean, I hate to say that. I mean, it
oh,
sounds weird.
was she calling you up and telling you, "Hey, Dennis, well, what's it doing? Oh, what? It's down 1%. You got to sell that." Well, was it
But
something like that, or
believe
what
it or
happened?
believe it or not, that's a great. Thank you for that question. Believe it or not, what mom would do is every day she would log on to her brokerage account. I made the bad mistake of getting her a laptop, and and she would log on to to her brokerage account, and she would do exactly that. She would go, well, that investment in Apple just went down $10 on today. What's going on with that? Why is that happening? And I go, mom, there's going to be fluctuations during the day, because she was just not used to that kind of situation. The ebbs and flows of the market. She wasn't, but she'd call me. She said, are you watching this? And let me tell you, that took a lot of energy out of me. So anyway, so yeah, that funny that you would mention that. But so the ways that trading are like gambling, I guess we'd have to. You already hit one of the big ones, is because before I jump into that, okay, there are some professional gamblers who successfully gamble for a living, right?
Right.
And while you said, yeah, that trading is like gambling a little bit, I I think there's two different definitions of gambling. There's one, the professional gambler that takes risk, but they are what do you call them? Calculated risk,
Right.
and they know the game inside and out. And then there's the gamblers who are the ignorant gamblers who are just there to help the casinos be profitable. You know what I'm saying?
Sure.
And so I can see, like, um, but trading, I don't, I think it should be more like professional and who has an approach. But one of the things that why trading can be like gambling is they trade they don't have a trading plan,
Right.
right? And so what are some of the other things that a trader, what makes trading like gambling?
Well, I think they need to have some sort of a risk management strategy,
Okay.
right? So, how much are you going to risk? Uh, when are you going to cut a loss? When are you
Mm-hmm.
going to take profits?
Right on. Yeah.
Right?
And so,
Because that's something that happens to a lot of people too. They'll write it up, but they'll write it right back down.
yeah.
Just like a roller coaster, right? Like, oh, now we're back to the starting line. You have to get and wait on that 2 hour line to get back on the roller coaster, and
Right.
that's
Yeah.
not fun for anybody. So, how do we make sure that we get off somewhere near the top?
That's a great question. And we're going to be covering some of those. How do we put the odds in our favor in just a few minutes? But
Mm,
no, that's a great question that needs to be answered in the plan and also the risk management. What about the concept of emotional trading? Uh,
uh,
that I think clearly puts emotional uh, emotional trading. It oftentimes our emotions can cause us to, even if we have a great plan, to throw the plan out and we don't follow it for
why
whatever
do you think that
reason.
happens?
Huh?
If you have a great plan, why do you think it gets tossed? Why do you think people toss out a great plan?
Well, I think it kind of goes back to the movie Sierra Madre.
I haven't seen it. Tell me about it.
Sierra Madre, they've got a famous line from that, and it's along this line. But like we always say, people should take profits at certain levels. Buy, sell on strength, and then also always have a stop loss.
Mhm.
Um, in Sierra Madre, it's this uh, a bunch of a horde of bandits were basically accosting these two guys, and they said, "Hey, we're the deputies. We're the deputies."
Hmm.
And the guy, well, where's your badges? The guy asked him, and he goes, "Badges? We don't need no stinking badges." and and it's this kind of the same way with traders, right? Stop losses. We don't need no stinking stop losses. And the
Oh my
fact of the
goodness.
matter is when I learned how to use stop losses properly and also take profits properly, it changed my trading world dramatically. It just whipped it right around. And guess what? It put the odds in my favor. So I think, that's why I think they just kind of throw it out. We don't need no stinking rules, or it's the old, they forget to put in their stop losses, and then it does what you said. The pops up, falls down, hits your break even point, and then continues to fall. And they say that prayer of every trader. Oh dear Lord, if you'll just let it get back to break even, I'll never do that again. Right?
Mm,
And so, what about over leveraging?
that's a big one too.
So how could that?
That's a big one, especially. I think that's probably going to happen. That's happened plenty in the past. I think that we're in a point in time where we'll probably see that happen even more. The reason why there's a lot of people that are hurting right now. A lot of people that are
True.
struggling financially. Uh, there were stats that were put out that like the savings rate in the U.S. is at some of the lowest levels that it's ever been.
Wow.
People are behind on credit card payments. Things like buy now, pay later. That's en fuego. So how are people going to get out of that financial jam? Oh, gee, well, if I take some money and I put it into the market and I try to hit a home run and I could just have this one trade there that's going to go up 10%. And if I could do that on my whole account, 10% instead of just one trade and, makes slow or steady progress, then I could get myself out of this jam.
Yeah. It's kind of like what you were saying about that the thing that you read that you saw on the YouTube about a guy says, well, if I can make $500 a week, right?
$500 a day. This guy wanted to
Oh,
do
$500 a
500
day.
a day
Wow.
on a $50,000 account with the objective to make 10 grand a month on
And
50 grand.
and the thing about, that kind of thought pattern is that, is it statistically possible? And the answer is yes. However, the probabilities of doing that are very low. Why is that? Is that trading and the way we reap our profits is a lot like a commission job. And commission, people who work at commission jobs, it can be either feast or famine.
Mhm.
and sometimes there's zero coming in. The only difference about trading is sometimes it's a negative number coming in, which is and that's just the ebbs and flows of the market, and also the attitude and the ego that they bring into the trading. So cool. The last thing. Speculating instead of analyzing. What about that? How does that kick you into?
So I would to me that sounds like the kind of person that uh also there's no plan involved, right? So there's no
Yeah.
trading plan, no business plan, no kind of a model book that says that, okay, here's specifically what I'm looking for. If what's in front of me how well does that match the model? They don't have anything like that. Well, what this person sounds like, speculating instead of analyzing, that would be like, maybe I heard a hot tip over on X, or I heard something on this news program. Oh, let me go take a look at the stock. Oh, it's going up. It's up 5% right now. Oh man, the story sounds amazing. Let's buy.
Yeah.
Uh-oh.
Yeah.
Where did my
Right.
money go?
Did you know that there are actually some people who are on X and some people who are on Instagram who basically will hype a stock, especially the lower price stocks, the penny stocks, and that comes, they hype them just so people will do exactly what you said. They will buy. But the reason they have an ulterior motive, as soon as they get enough people buying, they get themselves out of the position for a small profit, leaving the other person holding the bag. I don't know what percentage of that happens, but that is what happens oftentimes. And so I got a question for everybody. Hey, I want to thank everybody for joining us today. And we're going to be getting into the how you can put the odds in your favor here shortly. But in the comment section, if you would like to become the casino, then put a Y in the comment section. Just put a Y. Say yes. Or just type casino. Yeah, you want to become the casino. And we're going to explain to you why you want to become the casino here shortly. So just, all right. Casino. All right. Loving it. So, okay. So how do you become a casino and why do you even want to become a casino? Okay. Both the casino and the gambler are playing a game. And however, the casino typically always wins because the odds are only slightly in their favor. They're not hugely in their favor. But
Right.
with enough trades or enough, chances, they come out well ahead and make really good money. So what are the five, some of the five things that how traders can become more like the casino?
Well, one is to understand that the casino always wins. They're not winning on every single hand, but they always win at the end of the night.
Okay.
Right? So they're not trying to win every single bet. They know that sometimes they're going to win, sometimes they're going to win. That's perfectly okay. They're not trying to win on every single one, but they've got the odds stacked in their favor where statistically they know that, all right, there's going to be this many hands played tonight. I know that based on what typically comes in, and these stats that we're going to make this amount of money.
Okay.
And it's not a probability. It's not a hope. They know, because this is what the math tells them.
Yeah. Yeah. And so, I think part of the thing is, like you said, they have a system that is in their favor. They actually, casinos have risk management. That's why they have all those mirrors, and they have all the cameras watching the tables. And if somebody comes in who has a better system than they do, they don't let them stay in the casino very long, right? In other words, the card counters get kicked out.
Right.
Now, what about diversification? And then one thing that's really big, huge that I see is emotional neutrality. Now, you're the mindset guy. So what the heck is emotional neutrality?
All right. So, well, when I hear the term emotional neutrality, I'm thinking that you're okay with whatever the outcome is.
Wow. Okay.
Right. So you're approaching the trade from a perspective where, like, okay, I have a certain expectation that I wouldn't be getting into the trade if I didn't expect that the trade was going to win. But I'm not expecting this trade to win, if that makes sense. Meaning that, like, I'm open to the possibility of being wrong.
Okay.
And from a neutral perspective, you're probably also thinking, well, what's the other side of the trade thinking? If I'm a buyer, why is that person selling?
Yeah.
If I'm a seller, why is that person looking to buy?
Okay. And I agree with that. It basically, what you just mentioned is a lot like what Mark Douglas said about just becoming an observer of the market without judgment. In other words, just let it talk to you. What is the market telling me right now? Do I have an edge? And that edge that Mark Douglas talks about is what puts the odds in your favor. Now, does your edge always work out? No, it doesn't. But if you know that greater than 50% of the time your edge is going to work out, you can be very successful with your trades if you've got a profit to loss that is like 2 or better. You're going to do really well if you're hitting 50% batting average.
Right, exactly. You flip a coin, you get paid $2 if you're right. You lose $1 if you're wrong. I'll play that game.
Okay. The other thing, the casinos have a long-term perspective, right? They're or long-term from the aspect of they know that the numbers are in their favor, the large numbers, because they have multiple games going on. They've got the slot machines, they've got the roulette tables, they've got blackjack, they've got all the other types of. So they have multiple areas going on, and so is to have that diversification. Do we as traders really need that though? Or should we just focus on one or two strategies?
I think there's a few different schools of thought on this one. I think that the Warren Buffett types might have a little bit wider diversification. I think that the people that are following O'Neill, like you and I are,
Right.
would probably be a lot more focused.
Okay.
I think the quote I'm thinking from comes from Stan Druckenmiller, like to have your eggs in just a handful of baskets and then watch those baskets very closely.
Right. Right. So, well, people may want to know right now, Mike, is okay. How many stocks do you want to be invested in, or what's your max number of stocks? You'll say, okay, I want to be in X number of stocks. You're not necessarily filled in it all the time, but you've put a limit on yourself. How many stocks is that?
For me, most of the time, limit tends to be about 8.
Okay.
Sometimes it'll be more. Like if the market is extremely high and I've already made profits, and let's say I have that 8, I've hit my max,
Right.
but I've been able to take profits on those 8. I've raised my stop to break even or better, where even if price fell, I'm still profitable on those 8. Then I might add a 9th or a
Okay.
10th or an 11th, because these are all secure. And so I'm able to add another one. But generally speaking, 8 is the about as high as I get, and on average, I'm probably holding about 5, 4 or 5.
Okay. Okay. Yeah.
How about you?
The yeah, I approach it from the same perspective. I'll look at probably 5 to 6 stocks and then 2 to 3 ETFs for a total of 7 to 8. On occasion, it gets up to 10, but when it does get up to 10, what I do is I start looking at my weakest entity to kick it to the curb, saying, okay, you're not
Mm,
performing. So it may have been a top round draft choice when I first bought it, but it's no longer performing. It's kind of like the guy up, I think he's the Chicago Bears quarterback, who they're kicking to the curb because he's so just he's not a very nice guy and certainly not a great
mm.
teammate. So they're going to kick him to the curb. I can't remember what the guy's name is. Does anybody know what his name is out there in in on
YouTube
YouTube?
land?
Huh?
Yeah, in YouTube land or X land or wherever we're speaking
And
to
so,
today.
so yeah, just so why should a trader become like the? Why should the trader want to be the casino? That's a great question.
Well, do you like making money?
Yeah,
If you like
yeah,
making money, then be more like the casino than the gambler that walks in. Most of the gamblers that walk in the door are walking out with less money than what they started.
okay. So they leave some of their money there. So, um, so they basically have a mechanism where they're making consistent
Right.
profit, and and they call that they achieve consistency. So, what are 3 or 4 seeds of consistency?
3 or 4 seeds of consistency. Well, you should have not just have a plan, but your plan should be proven.
Mhm.
Right, so it's not just something where you're shooting in the dark. Well, I made this plan of how I'm going to make a fire, right?
Right.
And I just cooked this up. That I've got a couple of pieces of paper here. I'm gonna crumple them up, and I'm gonna start rubbing them together real fast and see if that works. Well, you don't have to do that, because there's people have already figured out how to make fire, and people have already figured out how to trade successfully. So we could go off and model success. We just need to figure out well, what style do we like? What resonates? Then
Right
we could
on.
go
Yeah.
off and model that, and that puts us way ahead of the curve, way ahead of where we would be if we were just trying to come up with a plan all by ourselves.
But that, oh gosh, that is a huge trap. We'll have to take that up on a future episode.
What's
Is because so many beginning traders, they walk in and rather than have started by going and reading some great books like William Neal's book, your book, my book, uh, that provides a successful plan right out of the get goes. I mean, it's almost like just pick it out of the box and start plugging it in. It's not totally a 100% plug and play. However, we humans have for whatever reason, have this innate, complex, limiting belief that, well, I've got to figure it out myself. I have to either design it myself, make a new system, and all that kind of stuff. And I would say if traders could get past that during their first 90 days of learning how to trade, they could reduce their learning time from 5 years to learn how to be a trader to less than 1 and be profitable in their trades. Are they going to learn it, know everything? No, they're not. But they'll know enough how to be profitable, which for many, that's all they need. Rather than, because I mean, both you and I went through the desert and went through the wilderness of learning how to trade on our own and all that type of thing. Even though we did have various mentors and all that kind of stuff, I know I stubbornly stuck with my approach, which was basically no approach, for years. That if I would have just said, oh, this William O'Neill guy, yeah, his process works really well. Why don't I just follow that? But what was going on inside of me was going, no. That's nice, but I'm an engineer, and I know I can make it better. So,
well, let me ask you this then to follow up on that point. Let's say that somebody buys into, you know what, I think I am going to get some help from somebody, but I don't know who I could trust because there's a lot of people out there that are trying to screw me over. How do they figure out who they should trust?
Well, I think there's a couple of ways. One is look at their track record. Okay, what kind of track record did they have? Is it are they flashing around a lot of single trades where they made, like an option trade where they made 1,000% on it, which is, that's great, that's wonderful, all that kind of stuff. But look at their whole body of work, because just because you make one option trade and makes 1,000% does not necessarily mean you're a great trader. Okay, it may be a great story, but so are big fish stories. They're really great, but it doesn't mean you catch fish all the time, right?
Mm.
And so look at their track record. Where are they listed at? Have they put it on the line by writing a book about them, about how they trade, like you've done, I have done. We put it out there. How else? When you go into their service, do they help you walk through it? Do they have a guarantee? Like I know with autopilot trading, if it's not a fit for somebody, if somebody wants to become a premium member, I have a 30-day money back, no lie guarantee. They can try it for 90 days. I suggest that's what they should do. But after 30 days, if it's not for them or if they're not for me, I give them a refund and say, sayonara, buddy, we'll see you later. Hasta luego. And it's okay. I mean, it's okay because, as you say, there are some on a pilgrimage out there to find the Holy Grail of trading, and they don't recognize that the Holy Grail of trading actually resides within them, because they have to take their "I want to learn how to trade" and convert that to "I will learn how to trade." There's a huge difference between "I want to" and "I will." When you will pay the price it's going to take to become a great master trader like you and I both have. So I don't know if I answered your question or not, but it sounded really good.
Yeah, it did. I think that's going to make for a great clip later on.
Okay.
So let's see. Well, what else do we need to be a casino?
Okay, we promised everybody at the beginning that we were going to basically show them how to put the odds in their favor. And while everybody, all the folks are online, their keyboards must not be working today. And so, but if you guys want us to go on and let you know how to put the odds in your favor, please put a Y in the comments section, and I'll wait. Let's see. Yeah, and you and I don't count, Mike. There you go.
Oh, well.
So that's all right. So, well, I have come up with 6 areas and ways you can put the odds in your favor. And one of the things that we talked about earlier, Mike, is probabilities, which is what we're talking about here, probabilities they seem like they're really complicated, right? I mean, and they are. I mean, I took some probability classes in grad school and didn't do very well at it. I was terrible at it. However, you don't need to be a rocket scientist to be able to figure out whether or not the odds are in your favor. And what I'm talking about is just, better than 50%, that
Right.
that there's the tendency for this to happen. If you know the tendency, you put the edge in your favor. Number one is learn how to trade with the trend. So how does learning how to trade with the trend put the odds in your favor?
Oh, you asking me?
Yep. Yeah. Yes, I am.
Well, the way that it helps to put the odds in your favor is that it lets you know if you should be long or short.
Okay.
That's one simple way. If you see that prices are going up, then it might be a good time to start looking for stocks that are also going up. If prices are headed steadily lower, right? Like for most of, say, uh, the bear market that we just came out of, right
Right.
between 22 for most of 22.
Right.
You might have found a couple of nice bear market rallies here and there, but for the most part, prices were headed down.
Right.
It was a
Right.
better time to be short.
Okay. So,
So if you understand the type of environment that you're in and you can identify those trends, then you could trade with the trend instead of against the trend.
okay. So if we were to make a checklist here, so that would be one. What's, if a stock is going down and I want to trade it to the upside, that would be a low probability trade for me to
Right.
take to try to trade to the upside.
Right.
So,
And to add to that too, before we move on, you have to come up with, well, what defines a trend?
oh yes,
Right?
yeah,
Because I used to be guilty of this too. I would walk in and be like, "Oh yeah, I'll follow the trend." What the heck is a trend?
yeah,
Does it just mean you have a couple of the higher highs and higher lows? Well, sure. Well, for how long?
yeah.
From
So,
on what time frame? Yeah. So trying
well,
to
okay, that
identify what constitutes a trend, and once you have a good definition of it, then you're good.
well, what's your definition, okay, for a trend?
Well, I like Stan Weinstein's definition of trends, like a stage two, where he analyzes the market and he goes into stage one, stage two, stage three, stage
Right,
four. Yeah, you know this, but for the sake of the audience, so basically, stage one is where the stock is basing, or you're just moving sideways. Stage two, you start to move up, and
right,
the thing that he's looking for is that you want to have both the 50-day moving average and the 200-day moving average both pointing north.
right.
That lets you know that you're starting to create this longer term trend that's heading up.
Yes,
And the reason why you want to identify there is because when a stock starts to pull back and it's still in that longer term move, it's more likely to bounce when it gets to some support areas,
right on. Yep. See,
right?
and
Just like
all of
this microphone over here, right? You start to come in, and then you bounce off of it. Just
and the thing about what you're just describing there, those flag trades or those bounces off support, those are things that put the odds in your favor. And so by knowing what you just described, that once the trend is shifted to the upside, that I know that my higher probability setup is going to be a bounce off the moving averages, or a level of dynamic or static support. So excellent. You mentioned something really quick. You mentioned the aspect of the prices being above the 50 and 200-day moving average. I know Mark Minabini uses that as a determination on whether he's going to take a trade to the long side, correct?
Mhm. Yeah.
And I think even in Bill O'Neill in his book also says the same thing. And so when two really great wise traders start saying this is what needs to be in place, for taking a trade to the long side, following their wisdom puts the odds in your favor.
Right.
Yeah. Well, I didn't know this would be this simple. No.
Yeah, me too. This simple after failing for a decade and then floundering about for another year or two and then finally gaining a little bit of traction. It was failing for 10 years to get to the starting line.
Yeah,
and then finally starting to figure stuff out after that.
Yeah, and so you did it much quicker than I did, and so one of the things is I always also look for high liquidity, and what that means. Again, it's a check in the block. I want to see volume that is over 400,000 shares per day. That's my minimum. If it's below that, I don't bother with the stock, because what I found is that higher liquidity stocks and ETFs with higher liquidity tend to have better underlying support. Now, I'm not talking about like a level of support, but they're not as prone to getting whipped around when the market turns in the bad, in a negative direction.
Mm.
And then let's see. Let's take a look at a couple of these others. And the one I'm going to wind up with at the very end, I really need your input on this. This one, Mike, is, but this is not the last one. But I want to see my momentum indicators starting to shift up, or the longer term momentum indicator on the weekly chart starting to shift up. That's telling me that now I'm in a new uptrend. And that tells me that my higher probability, the odds are in my favor for trades to the upside. Whereas if my momentum is shifting down, I'll say, no, I'm going to wait. And because it forces me to wait, waiting puts the odds in my favor. Right?
Yeah, absolutely. If it's not an A+ trade, then what are we doing?
Yeah.
If the trade is not in your plan, then what are we doing?
Yeah, exactly. I mean, it's and what a trader has, I'll give you a warning sign here, is traders have to be very careful, even if they are, visually trading off of what they think their setup is. If it's been a while since you had a good trade, or you had because sometimes you'll go on a drought for like 3, 4, 5 weeks before you really get a great setup.
Yeah,
and during that time frame, you just got to sit on your hands, right? But our memories, our eyes will sometimes fool us into seeing things or seeing setups that aren't there.
Yeah.
So that gets.
You play poker at all?
Do I? No. It's gambling.
It is. It is. And I'm not much of a poker player either, but the handful of times that I have played the poker, I just remember there being a big blind and a little blind. And that just means that for every hand, you've got to put in some money before the rest of the cards are dealt. And so the difference between trading and playing poker is that you could just sit on your hands the whole time until you get those pair of aces that come out, and then you're like, all right, I've got the 2 aces in my hand, now it's time to bet. Everything else you could completely disregard. Whereas in poker, well, I got a 2 and a 3. Well, I've got to play at least add the blind back in.
Okay.
So trading should be easier to make money than playing poker.
One would think. And so, okay. The next thing is how to put the odds in your favor is, unless you're up 10% on a particular position, exit before earnings, because the odds about earnings is that there's a high probability that the stock will move either plus or minus 10%. And if I'm only up 10%, that would put me back at break even. And with the volatility I've been seeing here lately, they've been dropping 15% or more. So if I'm not over 10%, I exit that position and just ride out earnings. And if they're good, if they have blowout earnings, take off like a rocket ship, guess what? I can always get back in.
Mm.
So, and we're saving what I think is the best for last. Is if you really want to put the odds in your favor, do this. Only focus on one or two setups and triggers. One or two setups and triggers. How does that put the odds in our favor, Mike? How does that simplify our trading? How does that well, if I say any more, it'll reveal the rest of the question.
Well, it adds a lot of clarity. It adds a lot of focus. You only have just a couple of ingredients. It's almost like you just reminded me of some like baking bread. Right? Melissa and I started to bake bread recently, and we have the recipe, and there's really just 4 ingredients in there. When you go and buy a loaf of bread at the supermarket, right? Like, let's say you bought some Wonder Bread. You take a look at the back, and there's 15, 20 ingredients in there. That's pretty complex. It's not very healthy for you. And if you have that many ingredients for your trading, that's not going to be very healthy for you either. It's not going to be very healthy for your bottom line and for your equity curve. If you have less inputs, it makes it a lot easier to make trading decisions. It's actually a quick story, if I could share, too.
Certainly.
This is a story that I heard my friend Adam Robinson told on Tim Ferriss's podcast a few years back. It had to do with horse racing gamblers. And so they gave these horse racing gamblers a blind test of just pick the horses and see how you guys do. Well, they were right maybe about 10% of the time. And then they said, okay, we'll give you 5 pieces of information, any 5 pieces of information you want, and then we'll see how you do. And so some people wanted the height and weight of the jockey. Some other people said, I don't care at all about that. Tell me what kind of weather conditions this horse likes to run in. And so they could pick whatever they wanted. And so across the board, on average, they were right 17% of the time. Right, so a 70% increase, right? And then they asked them another question: how right do you think that you would be? And so they thought that they would be right 18% of the time, right? So pretty good calibration. They were right 17%. They thought that they would be right 18%. Okay. Now it starts to get a little bit interesting, because then they gave them 10 pieces of information, any 20 pieces of information, all the way up to 40 pieces of information. What do you think happened? Well, when they had 40 pieces of information,
I will take a wild guess that actually by the time they got to the higher number of variables, their predicting capabilities went down dramatically, probably worse than it was when they had no information. I've never heard this story before.
So what happened was that they actually flatlined at 17% accuracy. They weren't able to bet any better with 40 pieces than with 5 pieces. But what happened was that their confidence went through the roof. They thought that they would be right closer to 30% of the time than the 18%. So when you're a lot more confident, what happens to your sizing? What happens to how much you're willing to risk? You end up risking a lot more. And so performance went down because they were overconfident in all this extra information when all they really needed was 5 pieces of information to do well.
Oh, wow. That's a mind blower. And we'll have to touch base after we're done here, because I would like to get the references on that story, Mike. You know why?
Yeah, absolutely.
You know why?
Why is that?
Is I run into traders all the time who have this thought in their mind, well, if I just know more, I'll become a better trader. And they don't realize that, no, part of the thing in simplification and clarity is, let's just pick a few things that you must know that will improve the odds of you being successful, and you leave the rest of it alone. You leave the rest of it alone. And that's why you can learn it later. You can learn it later, but it's not something that is an absolutely have to have. So what I find is a lot of traders, they want to know too much. They want to know too much, and it actually keeps them from being more successful. Ooh.
Yeah.
So, which brings to my mind is, okay, we're really excited to have Jeremy Newsom on this podcast next Monday, the 20th. If you know Jeremy, please reach out to him on Instagram, YouTube, on X, and all that kind of stuff. Great trader, great man of God, a marriage mentor, and with he and his wife. And I'm just looking much. I'm looking forward to having him on board. I've got some really great questions for him. One of the things I heard, and I'll end with this, Mike, is that Jeremy did a presentation the other day it was a little short, but it was brilliant the way he did it, from the aspect of, rather than calling he said, all you have to do is buy when the prices bounce off this blue line. Well, he didn't say what the blue line was. What it was probably the 50-day moving average. And think how much simpler it is by just saying it bounced off the blue line, because everybody can relate to the blue line. But as soon as you start labeling things, well, this is the 30.5 moving average. Well, that's when it blows up. And so we got a question from William Goff. Are there any secrets or tips to avoid the short-term capital gains of swing trading? And that's a great question.
If you've
William,
got an answer, I don't have an answer to that one.
Yeah. Well,
short-term capital gains for swing trade, I think that's kind of inherent in swing trading, isn't it?
It is inherent. Some of the ways that some people get around it, of course, are to swing trade in their
401k.
IRA. Their Roth 401k. Okay, because that way there's no taxes on those and that kind of stuff, and also on your 401ks, but you'll have to pay taxes when they come out. But that's a question. Get with your CPA, your accountant, to see if there is anything like that. And also, if you're a member of the Autopilot Trading Premium Service, you can always launch that question over on our Discord channel. So, Mike, what other words of wisdom would you like to leave everybody?
Well, market is trading has finally gotten back near its highs. I would say to be careful out there, because I think that from what I've seen, just from my Twitter feed and on Instagram and other social medias, people are starting to get a little excited again, seeing prices climb back up. And there's quite a bit of FOMO right now, fear of missing out. So there's always going to be another bus. Don't worry about catching this bus. Make sure that you get on the right bus.
Right on.
The right bus is going to be the one that matches your trading plan.
And so I'm leaving a message for William that One of the other ways around it's not around, can't get around the capital gains issue, but one of the things that I do is I only have a portion of my account dedicated to the short-term swing trades, and the larger percentage of the account is dedicated towards the longer term, what I'll call long-term swing trades, if you will, that I want them to last for over a year. And and so that's another way to, because if somebody has, 50,000, 100,000, 200,000, 300,000 or more in an account, and it gives us an advice, this is just something I've seen, is that you don't want to be swing trading with the whole amount. That would be taking the odds out of your favor, but you want to pick out, say, 20 or 30,000 or 50,000, depending on the size of your account, and do your short-term trading on that. But then on the rest of it, have it dedicated to a more long-term horizon. So, okay, William, if that works for you, and long-term. So, Mike, let's call it a day.
All right.
Okay.
Great advice, Dennis.
Aloha, and yeah, thank you very much. It was really, I think it was really good. So looking forward to next time. And let everybody know, we have gone to a 4 Monday a month session. So we will be having the Trading Truths every Monday, except for the 5th Monday of the month, or if the Monday is a holiday. So if you have any topics or anything you want to be talking about, throw a comment into either Mike's YouTube channel, my YouTube channel. You can catch us on X. Let us know what you would like us to chat about. And if you know anybody who would be great to come on as a guest, we would love to have them on. So aloha and God bless everybody.
All right.
See you,
Take care,
Mike.
all.